Hey folks, Dave Ramsey says mutual funds are better than ETFs, and I know he's wrong. So I'm going to set the record straight in this video, the truth about ETFs versus mutual funds. Let's go. Hello, everybody. It's Jeremy Whaley here from Trade Maestro. You can find us over at trademaestro.com. Hope you're doing fantastic today. And I got a video that I want to share with you. It's called The Truth About ETFs versus Mutual Funds. Put that up there here for you. And I was inspired to do this because I was perusing through some various internet videos over the weekend, and I ran across a video where Dave Ramsey says that mutual funds are better than ETFs. And I'm like, that ain't true. And I have a little bit of a personal issue with this on several levels. Number one, I fundamentally believe he's wrong. Number two, Dave and I live in the same city. He's about 15 minutes down the road from me, and I've never met Dave, so I want to just kind of state that clearly. I know lots of people who have worked for Dave in various capacities. I've never actually met Dave, and there's some things that we agree on. I'm sure that on a personal level, he's probably a really nice guy, and maybe we would get along at a party. Actually, probably we wouldn't, because we fundamentally disagree on a whole lot of stuff. But, I'm sure he's probably a really great guy. I don't know. I'm not trying to attack Dave's character in any way, but I do feel strongly that he's wrong on this issue. And I want to present my case for you, and then you can decide what works for you. And, if you decide at the end of the day that you're a mutual fund buyer and investor, then so be it. That is for you to decide. But for me, and for the way that I approach the market, I think that Dave is completely wrong. So let's talk about the truth about ETFs versus mutual funds. To kind of bridge this gap just a little bit here, let's start with explaining what an ETF is, just in case you happen to be someone who doesn't know what an ETF is. And here's what it is. An ETF stands for Exchange Traded Fund. ETF, an Exchange Traded Fund. So what is an Exchange Traded Fund? Well, an Exchange Traded Fund is like a mutual fund in the sense that it's a fund that has a whole bunch of different companies in it. So the idea behind a mutual fund is that you buy part of a whole bunch of companies together, and now you own all these different companies. And if one goes up, then great, the fund goes up. And if one goes down, the fund goes down. But, not one individual trade can sink the ship. That's kind of the idea. Mixing metaphors a little bit there. But that's basically what a mutual fund is. And so mutual funds have been around for a while. They're a very popular investment vehicle. And then around the late 90s, early 2000s, ETFs emerged into the marketplace, and they have really started to dominate because they are very much like a mutual fund in the sense that you own a piece of a whole bunch of different companies. But here's the difference. They trade on the exchange like a stock. Mutual funds do not trade on the exchange like a stock. ETFs trade just like a stock, which means you have the benefits of both. You have the benefits of the ease with which you can trade an individual stock and the diversification that you get with the mutual fund. And that's why I have said for over 10 years that ETFs are the mutual fund of the future. I think the future of mutual funds is doomed. And I think flat out Dave Ramsey is wrong. There, I said it. Now, there's other things that I disagree with Dave on. There's some stuff I do agree with Dave on. And again, I'm not attacking Dave's character in any way, but I'm going to share with you my belief of why I think Dave is wrong on this issue, and then you can decide what works for you. And I'll even share with you how I approach mutual funds, or not mutual funds, excuse me, how I approach ETFs, and how you might want to use that in the future yourself. So I'm going to break this down into what I'm calling Dave myths, because I went through a video that he posted up on YouTube, and I took these notes. So here's my notes for you. Dave myth number one: mutual funds are better than ETFs. Dave makes a big deal that mutual funds are better than ETFs, and I say, no, they are not. Why are ETFs better, in Jeremy's opinion? Number one, ETFs are easier to trade, period. And I had learned a long time ago, that Occam's razor is usually right. The easiest path is usually the better path. So I think it's better to trade ETFs because they're easier to trade than mutual funds. They're easier to get in and to get out. All you have to do is have a brokerage account, and you can pick up your phone and go and boom, there you go. You're into your mutual fund, or excuse me, you're into your ETF. Now I've got all my language messed up. You're into your ETF, or you're out of your ETF, and it can happen that fast. It trades just like a stock. And literally everything with that goes exactly the same. So if you want to get into it at 10:01 a.m., and let's say at 10:06 a.m., 5 minutes later, you say, you know what? I made a mistake. I think I need to get out of this thing. You can do it. All you have to do is just go right back in and boom, there you go. You're out of it. You can day trade an ETF if you want to. You can do whatever you want with an ETF. It has the ultimate flexibility of the stock, but it trades all these different companies like a fund. So it's very much the perfect hybrid. Okay, so it's easy to trade. It's easy to trade. You can get into it really easy. You can get out of it really easy. You can sell it short. Now, I know if you're a Dave Ramsey fan, you just probably might have just gone into some sort of a coronary freaking out. Sell short? I would never do that. But listen, folks, there's a reason that selling short is important in the market. It actually creates a fair market. It's a very important function of the market. And more importantly, it's one of the tools that we have to actually make money in a bear market. There's nothing wrong with selling short. When you sell something short, it doesn't mean you're betting against the market. It just simply means that you're taking a trade in that direction. And you do it all the time. If you've ever traded currency or if you've ever traded futures or anything else, you realize that both sides have to exist. Well, you can't do that with a mutual fund. With a mutual fund, you cannot trade it short. You are stuck in a buy and a hold philosophy. You must hold it for the long term. You must be in this as a long trade. That's the only option. But the market doesn't only go up over time. So selling short is a very good flexibility choice. Doesn't mean you have to use it, but it's a choice of flexibility that you have. Now, here's one that I personally like, and that is you can trade options on the ETF. Try doing that with a mutual fund. You can't do it, which means you have no leverage with a mutual fund. It means that you don't have all the advanced strategies and benefits that we get when we trade options. A really, really great tool. Now, I know, again, some of you are watching this, you're like, I would never trade an option. That's horrible. Well, maybe you should open your mind to that, because look, options, once again, they exist for a reason, because it's a really, really great tool for maximizing profits, for getting additional leverage, for lowering risk, for all sorts of things that we use options for. So those are limitations of a mutual fund. You don't have access to any of that when you trade with a mutual fund. But here's a really cool one. This is a feature you can do only with an ETF and only when you're trading options with an ETF. I can show you how to get paid before you even buy the fund, before you even invest in the ETF. What if you were to bring home 1 or 2 or 3%? Would that be cool if you could get paid 1 or 2 or 3% before you even made the purchase? And you know what? I know some of you are sitting there and you're like, no, there's no way I could do that. I don't want to get into options. This is a secret that even Warren Buffett uses. This little secret right here, how you get paid before you buy. Even old Warren Buffett uses this secret. It's in the line item of his annual disclosures that he puts out there. So no, there's nothing crazy about it. It's a little bit more advanced, yes, but it's a technique that you can use to increase your profits. And no, you can't do it with mutual funds, but you can do it. Yes, you can do it with ETFs. So again, another benefit of the ETFs. How about this? They're cheaper. ETFs are cheaper. You can buy an ETF in most cases for zero. That's right, not $0, but zero fees, zero commissions in most cases. Most brokers today will let you buy an exchange traded fund for no commission. Okay, so that means, unlike when I started trading 20 years ago, we used to pay $15 or $20 per trade each direction to get into a trade. Today, you can do ETFs almost for free, if not completely for free. Some brokers might charge $1, but it'll be really, really low, the cost of getting into your ETF. Contrast that with mutual funds. A lot of mutual funds have a load fee to get into it, a load fee to get out of it. They have a penalty that they charge you if you want to close it early. Sure, they'll let you get out of it. Let's say you buy it today and you want to get out of it tomorrow. They'll let you do that, but they're going to charge you a fee most of the time to do that. You don't have to deal with any of that with an ETF. So you just have so much more flexibility, so many more options, so many more choices. And then, here's maybe my favorite one. You know what to expect. When you buy an ETF, you are buying a specific set of stocks that's clearly disclosed what it is. You know what it is. You know what you can expect the performance to be. So, for example, if you're buying an index ETF, you know that index ETF is going to follow the S&P index or the Dow index or the NASDAQ, whatever it is that you're trading. You know that index ETF is going to follow that, and it's going to do it pretty much exactly. Okay, you don't always know that with a mutual fund. If you get into maybe you get into an index mutual fund And, that's going to follow the index pretty closely, but most people aren't doing that. Most people are trying to get into these aggressive growth funds that are going to try to beat the index. And I'll talk about that in a minute, but, you don't know what's going to happen. They may or may not beat the S&P index. They may attempt to, but it doesn't mean that they're actually going to. When you're trading the ETF, you know exactly what to expect. You have a really good idea of how that fund is going to perform, and then you have now the flexibility to get into that and to manage that in the best way that it's going to serve you and your overall purposes. So it's just so much more flexible. And to me, that slide alone right there, the one that's in front of you, that is why mutual funds are far inferior to the exchange traded fund. The ETF is far superior. That's why Dave Ramsey is wrong. No, mutual funds are not better. ETFs are better. Boom. There you have it. All right. Now let's go a little further. Dave also, in order to understand some of why Dave feels the way that he does about ETFs, you have to understand his philosophy of investing. And he talked a lot about that in the video that I'm referencing here. And one of the things that he says you can't time the market. Well, I'm going to take issue with that, and I'm going to share with you how we would time the market. Take a look at this and tell me if I don't care if you know how to trade the market or not. It doesn't matter. Just let me ask you a question. When you look at that, when do you think you should buy? Should you maybe buy when it turns green down here? So what if you were to buy down here when it turns green? Well, you would pretty much stay in this trade for the most part all the way up here until it turns red, right? So you get in here at roughly 260 and you get out here up here roughly around 480. So you have about $220 per share profit. What about all this red right here? Well, you don't trade. When it's all red like that, you don't trade, okay? What about this red over here? Well, you don't trade. You just say no. It's like that old drug campaign that Nancy Reagan used to do. Just say no. You just say no to the trade. Whenever it's red, you don't buy into it. In fact, you sit in cash and you avoid all the pain. But what about over here where it was green? Where it was green, you're in. Okay, now listen to me. I don't care what your education level is. I don't care if you went to high school or if you went to college or if you have a PhD or 10 PhDs. This ain't rocket science. In fact, I taught my 12-year-old to do this. That's how simple this is. What we just did is we just timed the market. What you just did is you just, with me, looking at that and recognizing and agreeing that green, we're going to go into this trade. Red, we're going to avoid the trade. You just missed out on two of the biggest bear markets of the last decade. Actually, the two biggest bear markets of the last decade. Just by simply following that simple technique right there. You don't have to understand it. You don't have to know why it works. You just need to know that it works. Let me show you, okay? If you had been in the market back in the 20 teens, and let's say when we got to, let me change my pen color here. We'll go to like blue, maybe. And when it came right here, when we turn red, if you got out of the market, let's say you just went to cash. Now, there's other things you could do that could actually make more money, but let's just say you went to cash. You would have gotten out when the SPY, that's the S&P ETF here, when it was around $330 a share. Okay, you would have bought back in when it turned green at $260. You know what that is? That is a $60 per share difference. That's 20%. Roughly, it's 20%. You know what you just avoided? You just avoided the market crash of COVID-19. Yes, this tool that I'm sharing with you right now would have helped you time the exit to avoid the market crash of 2019. Not only that, it told you exactly when to get back into the market so that you could participate in this incredible growth that went from 260 on this particular ETF all the way up to 480. And then you see the other side of the chart over here where it starts to have a bunch of red again. And I said you would get out over here. You know what you just avoided over here? 2022. 2022, when the S&P is down 25%, you've avoided that as well. Okay? And very soon we're going to start to get the signals that it's time to buy again. And if you haven't been following my market updates, then you can start following those and you can keep up with where we are in this. And what you would do here is you're timing the market, but you're also avoiding the pain. One of my biggest problems that I have with mutual funds is they have no way to avoid the pain of the bear market. Okay? And instead of avoiding the pain and instead of being what I call responsible for avoiding the pain, what do? They say endure the pain, dollar cost average, just keep buying in, keep buying in. When the market goes down, you're buying on discount. And they give you all these marketing messages. It's not trading. It's not really responsible. All of my friends who are real fund managers, professional fund managers, they actually do this. They actually time the market and get out whenever the market's going down. That's what I do as an individual trader. Why don't mutual funds do that? I don't know why they don't do that. I don't know why they're not more responsible with your money, but they're not. And then this philosophy of investing that has become the predominant philosophy of the last 80 years of just buying and holding and dollar cost averaging, that's all marketing messages that the fund managers use because they can't do this. They can't show you how to time the market and they can't go do it on your behalf. So of course they have to give you some marketing messages that justify not closing your accounts and leaving the money under management because they need to make the money for it. So I fundamentally disagree with this whole commentary that you can't time the market. You absolutely can time the market, and I think you should time the market because when you time the market, you can avoid the pain. Now let's come back to my chart here, and you know, if you're astute enough, you might notice a couple of little hiccups in here, and I just want to draw your attention to it because I don't want to try to hide anything from you. I just want to lay it all out there. You might have noticed these little hiccups right in here. Okay, you might have noticed there's a couple little red blips. Well, if you notice that, what you would notice is you actually would have gotten out briefly for about maybe a month. You would have gotten out here and back in here and then out here and back in here. You might have made a few dollars per share. You would not have lost money, but you might have made a few dollars a share. But for the most part, it was a break-even trade. So I just kind of left that one off. And then there's another one that happened over here. It's on the right side of the chart right now. It'll be on the, I'll be moving in a minute. But we had another situation over here. And once again, you would have actually gotten out about maybe about 445, and you would have gotten back in about 440. So you would have had about a $5 benefit to that trade. Now, I understand if you're the Dave Ramsey philosophy, then you say, well, if I just buy and hold, I'll avoid all that. I get that. But what if it wasn't the time that the market was continuing? What if it was another 2020? What if it was another 2022? And you didn't know when it turned bearish, you didn't know. It's much safer when we think about risk management. It's much safer to get out, lock in your profit, and then get back in when the signals present to get back in. It's just much safer. Now let's come to this more recent year here. And this has been a fairly difficult year to trade, 2022. But if you look at this indicator, in this technique for timing, it still isn't that difficult. We would have gotten out up here. I've already mentioned that. We would have, and we did, by the way. We would have gotten out up here when the market was around about 460, 465, maybe 480. Just depends on exactly how you timed it. But right in here, you would have been buying and then selling with just a few dollars profit, not much. And then you would have been buying right here and selling here, just a few dollars profit again. And then just recently, we've had another buy signal. I don't think this buy signal is going to run very long. We'll have to see how that one plays out. But the point is that even with the kind of back and forth and what we call whipsaws, where you're in and you're out, you're in and you're out, kind of these annoying market swings, even with that, you're still making money with this technique. So tell me how the mutual fund is better, and tell me how you can't time the market. Because I just showed you that you can time the market. Well, I can time the market. I believe you can time the market. So whenever somebody comes along and they tell me that you can't time the market, I like to say, no, you can't do it, but I can. But don't project on me something that you're not able to do. So, Dave, if you would like to learn how to time the market, I can help you do that. I don't think you're going to do that. I don't think you really want my help. That's okay. But some of you who are watching this video, you probably want my help. Okay, and I'll be happy to help you because that's what I've been helping people do for the last 15 years. All right, Dave myth number 3. He says mutual funds outperform. What? Okay, mind blown. Okay, honestly, this is the one that made me say, I got to do a video on this. It was this comment that he made, and I said, there's no way I can leave that one alone. So I want to draw your attention to a study it's called the SPIVA study, SPIVA, and it's put out every year by S&P, Standard & Poor's. They're the ones that do the S&P 500 and a bunch of different indices. They have indexes for everything. And I'm just going to draw your attention to a couple things in this study. This study, by the way, this one was updated at the end of June of 2022. So it's as recent as you can get. And look at this. Over 10 years, okay, so we're over 10 years. I'll write that up here. I don't want anybody to miss this out. Over 10 years, 90% of funds underperform the S&P 500. What? Said slightly differently, only 9.97% outperform the S&P 500. Okay, hold on. You're telling me that 90% of the mutual funds and the funds that are supposedly under management by the so-called professionals, they don't match or beat the S&P 500? That's what I'm telling you. Now, you would think over time it would get better. It doesn't. I'm not going to go into the details, but if you come to this website and you check it out, it's at spglobal.com. If you check it out, you're going to find some really interesting data, and I want to encourage you to dig into this data because most people don't dig into it. They don't know the facts. Just come to this page here, go to view more funds, and there's more data in here. And if you go to the bottom of this page right here, download the full report, you can download every bit of that data. And what you're going to find is over 20 years, the numbers get even worse. Over 20 years, it's less than 5%. Mutual funds outperform. Really? According to the statistics, and I've been studying the SPIVA study, I've been following the SPIVA study, looking at the stats for probably 8 years. I don't know, several years I've been following it. I'll give you the other outlier. You ready for this one? I mean, I'm intimately acquainted with this data. Here's the weird outlier. Right now, if you go to this website right now, the 1 year data shows that last year, 44% outperformed. This is the best number I have seen ever. It's the only year that I've ever seen that number perform that well. If you go to the 3 years, you'll see that it's only 14% over 3 years. So last year, the fund managers did pretty well. I don't know why, but they did. But over 3 years, 14%. Over 5 years, 15% outperformed. 10 years goes down to 9%. If you go dig into the data over 20 years, it's 5%. It's actually less than that, slightly less. 5% of so-called professional fund managers match or beat the S&P 500. So no, mutual funds do not outperform. So let's kind of recap here. ETFs are easier to get into. Mutual funds cost more. There's more load fees. There's penalties for taking your money out. ETFs are way more flexible. You can do option strategies. You can get in and out as quickly as you want to and as much as you need to. Dave says mutual funds outperform. They don't. They don't. Now, there's a few that do. There's a few. But in order for you to get into a mutual fund and funds under management that outperform the market, you have to be in a top 5% fund. And let me just be honest, most of you are not going to do that. Okay, so let's go to the next myth here that I'm going to bust. These two go together. It's myth number 4. But Dave claims in the video that his funds that he invests in beat the S&P 1.5% after fees. So what he says is he's saying that the mutual funds that he buys, they outperform the S&P 500 index by 1.5% every year on average. And that's after fees. And he's all proud of that. So here's my response to that. Woo, whoop-de-doo, 1.5%. Wow. That means on a $100,000 retirement account, it's an extra $1,500. That's not very exciting for me. Okay. You say, why is that not exciting? Because I can show you how to make an extra 1.5% every month with the same funds, without the load fees, without all the other junk, without the timing regulations, without all that junk. I can show you how to make an extra 1.5%, in some cases every 2 weeks, every 3 weeks, in some cases every week, but certainly once a month, and that's easy. I mean, making an extra 1.5% a month on S&P, no problem. And that also includes the underlying growth as well. So I'm sorry, Dave. I'm sure you're a nice guy. I know your family loves you. I know you got a lot of friends, and I know you got a lot of followers that love you, but I just think you're wrong. You're just wrong on this. ETFs are not inferior to the mutual fund. The mutual fund is inferior to the ETF, and that's just all there is to it. But I have one more reason that I think that ETFs are better than mutual funds. And here, it has nothing to do with Dave Ramsey. Well, it kind of does, but John Bogle. Do you know John Bogle? Here's what John Bogle had to say about this, and then I will tell you more about John Bogle. John Bogle is quoted as saying, "Now you can trade the S&P 500 index in real time," was the slogan in the newspapers for the first ETF. What kind of a nut would do that? That comes from John Bogle, the founder of Vanguard Funds. Now, why am I bringing up John Bogle? So it's kind of a weird quote because he's quoting somebody in the quote. But the punchline of this is John Bogle says you're a nut job if you want to trade an ETF. Well, guess what? John Bogle absolutely despised ETFs. He's dead now, but he absolutely despised exchange traded funds. You say, why would he do that? Well, a couple reasons. Number one, he's the inventor of the mutual fund, the index mutual fund that basically tracks the S&P. So basically the ETF comes along and it says, hey, I've got something better than what you created. So he's biased against it, right? That's the first thing. He's also the founder of Vanguard Funds, which is the largest creator of mutual funds in the world. So of course he's against the competition, the ETF. And he held that line strongly for years because his investing philosophy was the same as Dave Ramsey. You're just going to buy it and you're going to hold it. I could say Dave's is the same as John's because Bogle came way before Dave Ramsey. But here's the punchline here. Today, Vanguard is one of the largest creators of exchange-traded funds. Why? Because Vanguard sees the writing on the wall. Mutual funds are on their way out. ETFs are the funds of the future, and that's it. Anybody who tells you otherwise, they're just off. They just are, and I'm sorry, they just are. You know, just because you can trade it every 5 minutes doesn't mean you're going to, but it's nice to have that flexibility. The problem with the mutual fund is there's no flexibility to it, or very, very little flexibility to it. And for Bogle and for Dave Ramsey, you know, they say that's the benefit of it. No, I say it's not the benefit because we want freedom. You know, that's kind of the American way, is to have all the freedoms that we can have all the flexibility that we can have. It really comes down to the trading philosophy and the investing philosophy if you need to get in and out quickly. But the idea of the ETF is you can. If you want to, you can. If you need to quickly make a move, you can, and you don't get penalized for it. And that's what makes it so much more flexible. So, no, Dave, you're wrong. John Bogle's wrong. J-Dub's right. What can I say? Hey, is this interesting to you? Would you like to learn more about how I approach exchange-traded funds? I actually have a 3-day challenge that I've just put together, and we're just starting to offer this right now, and you can have access to this. I'm calling it Raging Profits with ETFs. It's a 3-day challenge, and let me tell you a little bit about it. On day number 1, I'm going to show you how you can use the exchange-traded fund to beat the so-called professional fund manager. I've called it Beat the Pros. And what we're going to talk about is we're going to talk about the truth about fund managers. Here, I'll make this a little bit bigger so you can see it. Talk about the truth about fund managers and the reality that 95% of them cannot match or beat the S&P 500. That's just the truth. I'm going to show you the benefits of the ETF, and I'm going to teach you a very simple system to beat the market. In fact, I started showing you that right now in this video. A simple way, green light, red light. How can you beat the market? How can you time it? How can you know when to get in? And that alone is totally worth everything. Like just coming to day number 1 is going to be the most valuable investment of your time that you can ever do. But we're not going to stop there, because on day number 2, we're going to come back and I'm going to show you diversification, how you can manage your risk better with exchange traded funds. With ETFs, you can use these to lower your risk. I'm going to show you a portfolio technique where with just 5 trades, 5 ETFs, you can get the ultimate diversification and maximization. And that's going to show you a simple portfolio maximization model that you can use in your retirement account, your IRA, your 401k. You can put it in your direct trading account, whatever it is that you're using to manage your money. You can use these models in that. And then finally, on day number 3, I'm going to teach you about trading for cash flow with ETFs, with exchange traded funds. I'm going to teach you how right now, in the middle of a bear market, you can start making profits in a bear market with these ETFs. I'm going to show you how you you can actually get paid every month to rent your stock? Did you know you can do that? Did you know that you could give somebody else the use of your stock while it's just sitting there in your account? You can give them the use of it, and you can actually collect monthly rental income. Okay, that's pretty cool. And then I'm going to show you that technique that I kind of mentioned just a minute ago about getting paid before you place the trade. How would you like to earn 2 or 3 or 4 or 5% before you even place the trade? Isn't that cool? Well, I'm going to show you exactly how you do that. And all of that is included in this 3-day challenge. This is certainly one of, if not the absolute most efficient and profitable way to beat the professionals and manage your own money. And I'm really excited to bring it to you. And here's the deal, folks. I could easily charge, $200, $300, $500 for this. But the price for you, because you're here watching this video, it's absolutely free. All you need to do is register for it so that I can send you the emails with the links to the live sessions or the videos. If you don't make the live sessions when we teach it live, then still sign up for it because I can send you the videos. And then you can still watch them and you can learn the same techniques and you can rewind the video if you need to. And all you need to do is just watch it and learn. I mean, really, what else is there? So all you need to do, depending on where you're watching this, there's probably a link below where you can sign up for it. If not, go over to trademaestro.com, and look for Raging Profits with ETFs. And we'll get you signed up for that and send you those emails. All right. Thanks for watching. Hope you guys have enjoyed this. Hope you got some good information out of it. And listen, if you're here on YouTube and you have not signed up, you've not subscribed for the channel, get yourself subscribed so you can get videos like this. You can get all my market updates and all the other cool stuff. I don't normally take on personalities like Dave Ramsey. I just happened to do it in this video. So let me know what you think. I know some of you love Dave, some of you hate Dave, who knows. I don't have a personal opinion that much about it. But anyway, hope you guys like this video. Hope you learned some stuff. Hope you learned some stuff about ETFs. I look forward to seeing you in our Raging Profits with ETFs 3-day challenge. And until then, happy trading to all of you. We'll talk to you soon.